So we're talking about some of the big tax changes for the year 2021 on today's program. And there certainly was a lot of them, the biggest of which was those stimulus checks that you got. Those stimulus checks, whether they be the ones that were generated last April, May timeframe, or the ones you just got this past week maybe, or the week before, both of those checks are actually 2020 items to be putting on your tax return. Why would you put it on your tax return? Well, if you didn't get all of that amount, and again, it was like $1,200 per person and then $500 for dependents back in April and May. This past week and the prior week, it was $600 per person, $600 per dependent. If you didn't get all of it, because remember, it's based upon the 2019 income tax return, but it was really given in 2020. So when you're doing your 2020 tax return, that's when you're sort of going to be truing things up. If you're like most people, chances are last year your income probably went down because the pandemic shut down some part of the income that was coming your way. So the benefit of that is that if you didn't get all of those stimulus checks, the 2020 tax return has a form and a mechanism for you to claim the remaining amount that you should have gotten. So make sure you do that. That's obviously a significant change that is unique to 2021 as we prepare 2020's taxes. So there's a bunch more we've got to talk about here on the program. So welcome back to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program, coming to you on the News Radio WFLA Orlando network, along with 96.9 The Game. We also happen to be one of the top 25 financial planning podcasts on the World Wide Web. Over 14,000 downloads of our show at last count. So we certainly appreciate our various social media and podcast subscribers. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life with a successful and cost-effective retirement plan that produces superior investment results and provides you with peace of mind for the future. So in terms of big tax changes, another big one is this coronavirus related distribution. We had an opportunity to meet with someone just this past week, and they had taken $30,000 out as a hardship from their 401k, and they had done that in the March timeframe, and they were assuming that obviously they'd have to pay taxes on it, but they were expecting to pay a penalty as well on that because they were age 43. So they weren't 59 and a half, long ways from it, but they needed to take that money out for various expenses, including medical. And so they were under the impression that they were going to also have to pay the 10% penalty as well. Well, here's the good news is that the standard for that coronavirus related distribution is pretty broad. And so when you start to kind of look at what qualifies for a COVID related distribution, as that term was sort of introduced into the tax law last year, it's a pretty broad category. And we think that most folks, if they took money out of their retirement accounts to cover things like medical or health insurance or rent or things like that, would certainly qualify for that. And here's I guess the benefit of that particular provision. Well, there's two benefits really. The first and foremost is that there's not a 10% penalty for early withdrawal. So that really works out well in terms of reducing down that cost. And then you also get the option to spread out the tax implications of that over the course of the next 3 years. So you can put that on your 2020 return, your 2021, and your 2022, and sort of evenly divide that up between those 3 years. It even gives you the ability to pay that back within that 3 year period of time. If you do that, then you don't have to pay the taxes. Again, if you've already filed sort of that 2020 return or that 2021 return, you would have to go back and amend to get that money, that tax money back, if for some reason you're able to put that money back in over the course of the next 3 years. So some pretty intricate tax work that's got to be done in order to deal with spreading the tax bill of those distributions out over a 3-year period of time. And then even more so, if you are fortunate enough to be able to put that money back in, then you've got to sort of work through that equation as well, including amending tax returns and all that. Nothing easy on that one, but the good news is that if you do it right, then you're able to spread out the tax liability and, most importantly, eliminate the 10% penalty for early withdrawal. So certainly a pretty important one there. And obviously that one, just like the stimulus check, pretty unique to 2020. We hadn't seen that one before, that is for sure. Here's another one that we have not seen before as well, and this was also part of the CARES Act, and that is this notion of being able to make charitable contributions and get a tax deduction for it. So for many Americans, the tax law shifted 3 years ago to make most people standard deduction folks. So if you're taking a standard deduction, then you just get the sort of the plug number, $25,000, and that's your deductions. The notion of using itemized deductions, which allows you to specifically write off your charitable contributions, got very limited because of the increase in the standard deduction. Standard deduction basically doubled with those tax changes of 3 years ago. So what that means is that many people weren't able to see their charitable contributions making a direct impact on their tax return like they did when they were itemizing. So back before 3 years ago, there was about a third of all taxpayers that were itemizing. Today, it's about 7%, with that doubling of what was the previous standard deduction. So many people are not seeing a direct benefit for contributing to their charitable organization. So what the CARES Act did is it said, okay, we want to start to bring that back in, to give people an incentive to make a charitable contribution and have them be able to see that that makes a difference on their tax return. So what the CARES Act did was it brought back in the ability for the year 2020 to do a front page before the deductions come into play, deduction of up to $300 for a charitable contribution. So know that that is new. So even if you take a standard deduction for the year 2020, you can still put in an extra $300, assuming of course that you gave $300 to charity. Then you can put in the $300 as a separate charitable deduction, separate and distinct from the standard deduction. They re-upped that for 2021, and they actually sort of doubled that up for a married couple. So for 2020, it's just straight $300. Doesn't matter whether it's a single return, a married return, or whatever. For 2021, it's $300 for a single return, $600 for a joint return. So at least you've got as a joint return the ability to do twice that. Similarly, for charitable deductions, one of the things that the CARES Act did is it eliminated the limitation that you have for making cash contributions. We got a variety of questions about this one, particularly as the end of the year was coming into play. Basically, typically when you make a cash charitable deduction, you're limited in terms of how much you can make relative to your income. So let's say you made $100,000 last year, and typically you would only be able to do a cash charitable deduction of $50,000, 50% of income. It's actually 60% of income, and then that's the limitation of what you would be able to do for a charitable contribution. Well, the CARES Act eliminated that and said basically if you want to give all of your income away as a charitable contribution, you can certainly do that, and we're not going to limit that. So that was another change, somewhat limited applicability. I don't know many people that are giving away all of their income to charity. If you are, hey, that's fantastic. But the reality is that that's a pretty limited one. A lot of charitable organizations were talking about that last year at the end of the year and sort of making it into something that wasn't really all that big of a deal, because you can still give a tremendous amount of your income away as a charitable deduction. So that's the latest on charity. We got a bunch of other things, including the return of the 3 martini lunch. We got to talk about that too, coming up here on the program after these messages.